But my guess is there'll be more companies, public companies, go out of business this year than I've seen maybe ever, but in a long, long, long time.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. When the road ahead is uncertain, there's no wiser choice than to listen to those with experience, who have seen enough market cycles to judge what's most likely to happen next. Today, we're fortunate to welcome financial advisor Ted Oakley, managing partner and founder of Oxbow Advisors. Ted has over 40 years experience helping clients, mostly high net worth families, protect and build wealth through good times and bad. And here at the start of 2023, we'll ask him if the bear market is over or if it's simply sharpening its claws, waiting to strike again. And we'll find out how he's currently positioning his clients' assets for the coming year. Ted, it's wonderful to see you again. Thanks so much for joining us.
Thanks, Adam.
Ted, it's always a great pleasure to interview you. Folks constantly ask me to bring you back on the program. Your wisdom, experience, and just ways to explain things in a very matter-of-fact way that the average person can understand is really appreciated by this audience. I have a lot of questions for you, largely based upon the recent Q1 update that you put out for your clients. But before we start walking through that, if I can just maybe kick things off here with a high-level question I like to ask you every time you come on. What is your current assessment of the global economy and financial markets?
Well, Adam, I think what's going to happen here is there's a few things getting ready to fall that hadn't fallen before, which were earnings. And I think that's going to have a major impact. I think people are not factoring in the weakness that's coming from these companies earnings wise. And I think that's going to have to be priced in at some point in time. So we look for the market to go to new lows. I don't know what that number is necessarily, but it's certainly not, I don't think it's where it is now. And we've had this, all year long, we've had this obsession with trying to catch the low in the market and the high in the rates so we could front run everybody. But they don't work that way. That's not the way things really shake out in the long run in a bear market. And so we'll see how it plays out. But for us right now, we just think that's where we're headed over the next few quarters.
Okay. So some more additional shoes to drop, but more importantly, to the question I put in the intro, sounds like you think the bear is just sitting on the side right now, sharpening his claws, coming back, and will bring the market to new lows at some point in 2023.
I do. One of the things I've noticed is that by and large, investors haven't gotten scared enough. It's interesting to us. They've lost money, but I don't know if they've been talked into it by Wall Street that, hey, everything's okay, so just stay with everything, or what it is. But typically, you'll have to get enough damage in those portfolios to where they finally say, hey, look, I'm out. I'm at least out a part of it. And that we haven't seen that yet. It's been an interesting turn for us this year.
All right. And you've got a chart in your update that we'll get to in a bit that shows that people are still pretty all in the market and positioned long, that they, even if they're talking a more cautious game, they're not putting their money where their mouth is yet. They're still investing like it's a bull market. All right. Well, look, like I said, you put together recently a great update for your investors. I want to share some of the highlights of that if possible for folks watching this video here. Let's see. It's interesting in that presentation. I don't think I heard you mention the word pivot once, and of course that seems to be what so much of the market is glued to right now. Is there an indication the Fed's going to do a massive pivot sooner than later, and we'll be able to ride a resurgence in asset prices because people are equating pivot with immediate higher prices and everything, which may or may not be the case in reality, even if one does happen. But you did say that you think 2023 will likely see, or maybe we've already even seen, the peak for both interest rates and CPI. And on the day you and I are talking here, they just released the December CPI numbers, which are showing that we do seem to be now in a pretty identifiable disinflationary trend. So I'll let you talk about that. Is that truly the case? You think we've seen a peak in both?
Well, what we were referring to on rates was not the short-term rates, not less 2 years and less, but the long-term rate really, because if you look back, the long-term rates, I'm talking about 20 to 30, they peaked a while back, and they've come off since then. Not to say they couldn't go back, but we don't think they will. And we're talking about long-term rates when I say that we think the rates have peaked, and we think, inflation, I don't know, was 9 points back in June, July, and obviously that's rolled over. But people have to remember that all of that takes place while the economy is tanking.
Right.
So as you go lower and those numbers get worse, then that means you're headed more and more into a recession. And then I think that's what they fail to understand on all of this. And for us, we just think that perhaps they're getting this wrong, and that maybe this time Jay Powell is in a mode where he's saying, hey, look, I wanted to get rid of this thing where the Federal Reserve is always the one driving the bus here. And so we don't want to just run liquidity in and support the stock market. Maybe wrong on that, but he seems to be going that direction. If in fact that's the case, then yes, your rates, the long-term rates can stay there or come down, and you can have CPI coming down as well. I do disagree with people that think that the short-term rates are based on the bonds, because if you want to see those 2-year rates keep going up, watch him just keep raising those rates, and the bonds won't go against that. They'll buy their treasury. So we'll see how the plan pans out, but we're talking about, that's what we're looking at right now on top of that.
Okay. And a good clarification. So short-term rates probably will actually go up a little bit more from here, simply if Powell's to be believed that he's going to stick to his plan. And I'll ask this question, even though it wasn't so much in your presentation. Powell has said, I want to get up to around 5%, and then I want to hold it there for a good while to assess the impact of all the rate hikes we've done so far as they, with their delay, begin to really hit the economy. We have recently had Jamie Dimon saying, there's a 50% chance the Fed might need to go higher than 5%, maybe up to 6%. And we had the trial balloon that James Bullard floated last week saying, I don't know, we might need to go up to 7%. But it sounds like you're saying, and correct these words if they're wrong, yes, that may play out a bit over maybe Q1, half one of this year, rates going a bit higher still from here. But in the short term, but you don't really necessarily see a clear trigger for why long-term rates should rise back up to the highs they were at, a few months back.
Well, it doesn't look like it. It looks like the inversion of that curve is just going to get larger, where you might even go to 1% or something, where the short rates are 1% higher than the long. It could very well be that way. And I do think people need to understand that if you look at the Fed funds rate, I don't think they stop that until that at least squares up with inflation. So it's 4.5 right now. Inflation 6.1, whatever it was today. You're still out of balance right now. So either one comes down a lot or the other one goes up more than they think. We'll have to see.
Okay, and you said that you think that, as a number of other folks that I've interviewed here, it's been interesting over the course of the year. A lot of the experts I interviewed on this channel really didn't think the Fed was going to be able to get as far as it's been able to get so far with hiking interest rates. But you and several others now think that Powell's real main focus here is, I don't want to be another Arthur Burns, right? I don't want to have us go through the period we went through in the 70s where they raised rates, inflation began coming down, so they brought rates down, and then they got another resurgence of inflation. So Powell, and again, don't let me put words in your mouth here, but it sounds like you think Powell is going to do what's necessary policy-wise until he really has confidence that inflation is stamped out.
Well, what happened during that period is right in the middle of the 70s, when you got that 73, when you got that big push on inflation. And of course, they raised the rates, and so it busted things back into the 73, 74 recession. It was a bad recession, so they came again with it, loosened up too much. They didn't let it, ferret itself out. And so what that did, then that pushed it to a new high. Arthur Burns is out, Paul Volcker's in, and then he has to really bite the bullet. And I'm thinking that Jay Powell is trying not to have to get into that situation.
All right. So my guess is you would say to the people just salivating for a pivot, you've got maybe more confidence in Powell's backbone than they do. And then another thing I'd love for you to comment on is if something were to force a pivot, let's say something really bad broke and it just bad enough that it forced Powell to really have to reverse policy sooner than he wanted to. I don't think that's going to be a bullish moment for stocks. That's going to be a crisis in the markets, right?
You're exactly right. What happens on those, and people, I think people that don't know a lot of history about the markets don't understand this, but if he came within the next few months, just a couple of months, and started lowering the rate, he was not going to lower the rates first. He'll keep them flat, but when they start lowering, that means they're fearful of things that are already happening badly. Okay. And then the markets react just like you're saying, they react poorly. See, all of that's ahead. We haven't even stopped going up yet. And that means we haven't flattened out yet. And we certainly haven't started going down. So I have no idea why Wall Street is so consumed with this. I mean, they're consumed daily with it. And I think they've really gotten it all wrong.
All right. And it wouldn't be the first time, right? So continuing through your macro outlook. So you said, yeah, so sort of expect interest rates to peak, certainly in the long term, but probably still in the short term as well, short-term rates at some point in 2023. Inflation probably has peaked. We're watching it come down now. You said that the economic news, you believe, is only going to degrade as we go further into the first half of the year here. One of the things that you mentioned, we'll put up this chart here, the ISM purchasing managers charts have gone into negative territory, which shows that we're now in contraction in the manufacturing space in terms of spending. But is all this true that you just sort of consider, you look ahead and just see this continued sort of just grinding down of growth and opportunity in the economy?
Well, I think so. And actually, just since we put that out, the services came out, inside services came out well, and they went into negative territory. And I think most people don't realize this, Adam, but wholesale drives the market, not so much retail. If you look at what drives the market, typically in the ISM, it's wholesale. And what that tells you is that the people that are producing, manufacturing, et cetera, they're saying, hey, business is slower. We're not buying as much. So that's where we're headed. And I think it may be the third or fourth quarter. I don't know, but my guess is at sometime in the first 1 to 3 quarters that you start to really see that take effect.
Okay. And I don't think you addressed this in your update, but in regards to that, where wholesale really drives is the dog and the rest is the tail. What's your forecast for layoffs, right? As companies get increasingly squeezed, the economy contracts further from here. Are you concerned that we could see wide-scale layoffs, the sort we've seen in past substantial recessions?
That's Adam, that's probably one of the hardest things to figure this time, because we dropped a lot of people out of the group. Now, I do think they're going to have layoffs. I mean, it's going to continue and it's going to get tougher. The thing about it is, and I know if you look at most small businesses and the good employees they have, they will ride with those longer than normal because they know they can't rehire somebody as good as that person. I'm involved in 3 or 4 businesses, and the thing about them is you try to keep your good people, even if it costs you more money than you normally would spend. And so that's a really hard thing, though, to figure. It's hard to figure out actually how many of those would do that. We think a number would, but unemployment will go up. I think unemployment has to go up, or he keeps the pedal to the metal here. I think that's one of the things he looks at.
Okay. All right. Well, look, you mentioned sort of what served you at Oxbow well last year was assuming a defensive position pretty early in the year. And kudos to you for that, because it was not a good year. It was for the markets, it was one of the worst ever for both stocks and bonds combined. So defense really paid off. Sounds like we'll get into the specifics of your allocation later on, but it sounds like you are maintaining that defensive posture coming into to 2023 here. You mentioned that last year the commodity side of your portfolio did quite well, specifically natural gas, oil, and gold. I think you've kept on the natural gas and the gold, but you've sold off some of your oil position, I think. Can you just very briefly explain why?
Well, the reason and it was probably came across a little bit differently in that what we sold was the big oils. You know, if you look at Devon or Chevron and those kinds of things, what we kept were oil royalties. If you look at, what we kept, Sitio, Permian Basin, those kinds of things, Texas Pacific. If you own the oil royalty and you're wrong on the oil, you'll still be right on the royalty, you see. And we get cash flow, better cash flow on the royalties than we get on the big oil. And we really felt like oil was coming down, and it has come down. And so, but we're still getting good payments on the royalty side. So that was not to make people think we don't think, we want some energy. On the natural gas side, we kept the pipelines. We did not keep any of the straight gas companies, because the pipelines are different in that they get paid on throughput. So we'll make that cash flow no matter, we're obviously at a very low price right now and an MCF basically on natural gas, but they still get paid and we still get paid. So that's how we set that up for those two things.
Okay. And I'm just curious, since we're on the topic, trying to map oil's investment outlook to a slowing economy. Do you have a strong sense of where you think oil prices are going to head in 2023 because the economy is slowing down?
Well, you're weak worldwide, with the exception maybe a few countries that are starting to come out, but the people forget about this. And I totally agree with them on the supply look, demand look on oil long term. But short term, oil is coming off for a reason. And everybody asks me this question all the time, well, why do you think it's coming down? I said, well, it's easy. They're front running a soft economy because you don't use as much oil. And that's where it is. It doesn't mean that the supply is not still reasonably tight and things are going on, but if you're not buying it, the price is going to go down. And so that's, as you go into these weak economic times, you look for oil to come off. That's all we're doing. And it's probably one of those things where we're out of it for maybe a year or so, and we'll be back. I'm talking about the big oil now.
Yeah. And I want to remind our viewers that your firm, Oxbow Advisors, is based in Austin, Texas. In other words, you have a very close proximity to the oil economy of Texas. I'm assuming a number of your clients work in the industry. So in other words, you're pretty close to the heartbeat of what happens in the oil market. You're not just kind of reading the papers and guessing. You're actually talking to people who have a lot of firsthand knowledge of what's going on in that market, and you've invested in it for decades and have a really good sense of how the trends work.
Well, I do. I will tell you, though, oil and gas people that are in the industry are not, they're sort of I use them as a contrarian group.
Because they're perennially optimistic.
Yeah. I mean, when the price is really high, they think it has to go higher. And when it gets really, really low, they think it has to go lower. I'll tell you just a quick funny story. And this was back in back in, it must have been 98 or 99. I mean, it was one of those periods here where oil went below $10. Okay. And so a couple of times I talked to producers and I said, how much does it cost you per barrel to lift that, And they gave me a number, and I can't remember exactly what it was, but it was 50% more than the price of a barrel was in the open market. And so this is how they think. And so I said, well, why don't you just go buy it? And they said, well, because it might go lower. And so, do you see what I mean? I mean, that you got to think about that. And so that's how they're a group that they can't take the deep lows or the high highs. It's tough on them.
All right. Well, look forward to, Ted, when you see the the winds of change blowing that's going to make you want to get back into the big oil majors, please have you come back on the channel here, and we can have you explain why. All right. Well, in kind of rounding out your macro outlook, you said that not only are we seeing signs like the ISM numbers that the economy is slowing, but we are seeing that goods prices are coming down. And again, today's latest CPI numbers do bear that out. And that it's funny, even though right now in today's numbers, again, one of the biggest contributors on the upside to the CPI is housing still. That's very lagging data. And if we look at a lot of the other more real-time data, it's very clear that the national housing market is beginning to roll over here. I assume you have that same outlook. And so I want to ask you, how substantial do you think this housing correction could be once it gets fully underway?
It's a bifurcated market because, Adam, what's happening is I suspect in the big picture, when it's all said and done, I would suspect that housing prices generally would come off 15-20%. I'm just throwing it out because that's what I would expect. And the primary reason is because if you look at where people are locked in to existing home, most of those mortgages are below 4%, and a lot of them are at 3%, and some are at 2.5%. And so when it starts up this mobility thing, they're going to have to lower the price to move that house if they have to move to another city. Right. Or let's say they have a couple of children now and they got to, expand. All of that works into a problem because you have all this group over here with really, really low pricing that has to be working in a market with really high pricing, and the two don't fit together. And that's why I think people are talking that way, and now we've seen it too in luxury homes. Finn, I brought this out in the call, the quarterly call we had, but one of the things that Redfin came out and said, hey, year to year, luxury homes down 38% as far as, and so that are selling. And that's what we're noticing too. Everybody used to tell us, oh, they've got cash or buying for cash, won't hurt that market. Well, didn't happen that way because I'm seeing more and more, even of our own clientele who have housing that's anywhere from 3 to 15 million, they can't sell them. Yeah. Some of them don't even get a look. Nobody walks in. So we're in the midst of that right now, and they're just going to, we have to deal with it as we go through this period.
And let me tug at this a little bit further, Ted, because one of the pushbacks I hear from folks on the topic of the market's going to decline substantially or not is they say, hey, people have these really cheap mortgages, they're just not going to move, right? And so they're just going to wait this out. But what people forget, or what I think they're forgetting, is that housing is priced at the margin. And that means you only need 1 or 2 houses in a neighborhood to sell to reprice all the homes in the neighborhood, right? And there's always going to be some percentage of sales in any market, just because people die, people get divorced, people lose their jobs, people have to move for other personal reasons, right? So there's always going to be some transaction volume there that is going to be doing the marginal price resetting. So I'm just curious, do you share that opinion that people are maybe not paying enough attention to that dynamic?
I think that's totally true, because the other thing they miss is that you've gone through a couple of years of extremely high home taxes. And so now taxes are so high, and see, that goes on top of the payment. Right. And people are not realizing that, if you look at it today, and I've got a number on this because I've pulled it before, but if you buy a new home today, the average person in the United States would have to spend over 45% of their income just on the home. And so that won't work. It just won't work. I mean, you can't make that work long term. So something has to happen. And I think it slows down the industry. Real estate industry has always been, and believe me, let me tell you this, I love real estate. I think it's one of the great investments, by the way. But, and I've owned it, and we own it, and we different things. But here's the problem. People are, they're more enamored with real estate than anything else. Most people think that very little can happen to real estate. Well, I've been through periods where a lot of things happen to real estate. And I'll just throw this out, these letters, RTC, if you'll remember that, that was a period where you could buy everything on the cheap, really cheap, okay? And they come and go. They're not as much as a stock market, but they have their periods, and I think we're coming into one.
Okay. Yeah, I would almost say, and you don't have to share this opinion, but like right now, if you're talking about a residential house, and look, of course, any particular geography is unique, and location, all that stuff. You can still find some good values in some little pockets. But in general, in today's housing market, again, for the consumer, I think this has got to be almost one of the worst moments in time to buy a house, because prices haven't really corrected yet from their all-time highs. But mortgage rates are more than double where they were, a year and a half ago, right? So you're kind of almost getting the worst of both worlds, the highest price and the highest financing costs.
And that is so true. And I think people forget about this, but these municipalities and state and counties have been on a free ride, okay, in 21 and 22. And so I'll give an example. I own property in Wyoming. They never go up very much in tax. They double the taxes in 22, double them, 100%. And so what happens is these cities and counties and states, all of a sudden they're on a free ride here. Now, that's another thing. When you go to sell that home, they look at, okay, I've got this interest rate, I got to pay this price, and on top of that, I have to pay this much in tax.
Right.
All of those things factor into a slower market, in our opinion.
Okay. So I imagine you would say patience. You're probably going to say this about the financial markets too, but in terms of the housing market, for those folks who are looking to buy real estate, my guess is you would say patience is your friend in 2023.
It is. I remember, a year ago or longer, I would tell people, and it was red hot everywhere, especially here in Austin, but everywhere else that we go all over the country. So it was red hot. And I would just tell people, hey, just wait on it. Things don't stay that way forever, and they'll break down on you sooner or later. And everybody was like, well, we can't do this, can't do that. Now it's starting to happen. But it's probably just starting. I think people in reality, they really don't believe it. That's one of the things I'm finding about the real estate market too.
Yeah, well, it sounds like, many things, people go through the 5 stages of grief, right? And the first one, I think, is denial, right? It takes you a while before you really are willing to accept it's happening, right?
Yeah.
I know in Austin, actually, I was interviewing housing analyst Nick Jurley last month, and he brought up the most recent housing sales and then housing price data, and housing sales, have cratered. They're down like 40 to 50% in most major metros from the prior year. But housing price declines were already beginning to pick up, and leading the pack was Austin, Texas. And it was a 15% decline just from May to November. That was the data set that we were looking at. I'm sure it's even worse now. So your advice for people, in Austin who are asking you to say, hey, maybe wait a little bit, has already turned out to be very prescient advice. I'm also really curious too. The last time I was in Austin, actually, I was visiting you on that trip, Ted. I was staying in a place where out one window I could see a building that was just being finished that Google was building, and then another building that was still under construction that Facebook was building. These were pretty big buildings in downtown Austin. And since then, those companies have both announced either hiring freezes or substantial staff cuts. Is anything happening with those buildings? Are they just going to sit vacant for a while, or what's going on there? Because you've been at sort of the hotbed, the tip of the spear of the speculative, fervor in big tech there in Austin.
Well, I don't know about Google, but I do know about Facebook because it's public knowledge now. The 23 floors they had in the new building here, I believe it's 23. They are not going to build out right now, so they could either elect to sublease it, or they could do nothing till they decide what to do. But either way, it's creating empty offices. And I don't have this number because I haven't done all the work on this, but I believe right now that downtown Austin probably has more square foot for lease than they've ever had. And of course, they have 2 very, very large buildings coming out of the ground as well. So, and we got a number of buildings coming out. So there's a lot of space around if somebody wants some.
Wow. And, that gets exacerbated by the whole work from home, movement that started from the pandemic. But also, as you said, we're here at the start of the year. You believe, at least for the next half of the year, but maybe potentially even further, we're going to see continued economic weakness, maybe further layoffs, as we mentioned earlier. So it doesn't bode very well for a lot of vacant commercial office space.
That's true.
All right. Well, look, let's move on to you did a section on bonds, you did a section on stocks. So on bonds, you very rightly, as I've been saying a lot on this channel, that higher interest rates have been killing borrowers, right? Both on the consumer side and on the corporate side. And because of that, it sounds like you sort of expect to see a certain reckoning, a certain die-off amongst the weaker, more over-leveraged players in the corporate system. I see you nodding as I'm saying this, but how substantial do you think that could that get?
Well, I will say this about a lot of the corporations: they were smart enough at least to take those really small, short rates, the rates when they were really low, and kick that paper out a long way. And the problem is we had so many of those companies that were just living on a string on basically floating rate debt. That's the killer, because as we roll over here, if that floating rate debt was at a 2, or some of them are actually at a 1.5 or something like that, they're going to a 7, or higher. So all of a sudden, that's what you get into. It's been hard to get a number on that because there's a lot of mezzanine debt that it's hard to get a number on it. You can see what's on balance sheets and different things of companies, but the public companies, but there's a lot of debt out there on private equity, on private companies, all various things that's really floating. And that, to me, is where the problem's coming in.
All right. I've heard people say, look, if we do indeed get a recession this year, it's not going to be as systemically bad as 2008 was, because we don't have the crazy housing loans that were being made, right? And there was enough housing debt and enough portfolios out there that it created this big contagion effect. And that's true. But we have all debt re-rating at these substantially higher rates. So it is kind of a universal injury to everybody that uses credit, which is just about everybody in the in the economy these days. You have a great chart here that just underscores how much bond yields have jumped in the past 1 year, right? Now, when you look at it from bond yields, we can look at it as an attractive, from an attractive perspective as an investor, but it also reflects the huge jump that just interest rates in debt have taken on. And so the cost of capital has gotten so much higher for corporate America. So maybe I'll put that chart up here, and Ted, you can talk to it any way that you like. But I just kind of liken this in some ways to, throwing somebody into the Arctic Ocean, right? You can die from the shock because you're getting chilled so quickly. I mean, we're kind of having a debt, or we're in danger of having a debt shock to the system here, correct? From how quickly and how high rates have changed.
That is true. And it's in a lot of different areas, Adam. If you look at a lot of the leverage out there, whether it be on a private business, private equity, a lot of real estate. I mean, a lot of multifamily. That's been brought out the last 5 years. Okay. And if you look at their structures, they'll typically have, maybe 15, 20% equity, maybe 20% fixed, maybe 60% floating. And it was great for them for about 5 years. But now they're going to roll all of that over. Same way with all of these companies that are leveraged. And when they roll, it's going to really change the cash flow number. And that is the problem, because then if you've got a lower cash flow number, you have to take a lower price. And I don't think people are thinking about that. I think they're sort of trying to glass over that. But if you look at it, though, that's what has to happen when you have lower cash flow. And that's what's coming from the higher rates.
All right. So when you have this concern, I'm just curious, like what sort of DEFCON level do you place on it? I mean, how big of a concern is this for you?
Well, I would guess, okay, this is a Ted Oakley guess, but my guess is there'll be more companies, public companies, go out of business this year than I've seen maybe ever, but in a long time, because number one, they're leveraged. Number two, so many of those public companies didn't even have any revenue. And if they did, it was minuscule. So those companies go away. And if you look at, you just go look at, we don't own bond funds in particular, but we really own straight bonds. But if you go look at a lot of bond funds, they'll jam a lot of triple B, a lot of triple B in there because it's investment grade.
Mm-hmm.
A lot of that paper probably is going to be then put down to double B, single, maybe lower. And that way it's downgraded. And when it gets downgraded, all of a sudden they have to kick those bonds out of whatever fund that was. And so that's a problem you're going to have too, because you won't have the buyers. And so that all of that's still coming, I think. And so that's why we've mentioned to people, don't underestimate how safe you need to be, because you can be in a lot of bonds that are not safe at all.
That's a great point to underscore. And, more people are waking up to bonds, I would say, this year. We've certainly had more conversations about bonds over the past 4 months than I've probably had in my life. And there's lots of good reasons for that. And I believe, Ted, your firm is pretty bond friendly right now, given the environment, but it very much depends on what type of bonds we're talking about here. And I'll give you a chance when we talk about your portfolio allocation to talk about the specific type of bonds that you're going into here. So I do want to underscore, though, that I believe, and again, correct me if I'm not stating this properly, but bonds are looking quite attractive in a number of cases here. And especially when you look at the bond yields we have today as compared to the dividend yields of the stock market, the past decade, there was sort of the mantra of there is no alternative, right, Tina? Well, now bonds are beginning to offer an attractive alternative because you can basically get a similar or maybe even sometimes superior yield or cash flow with a ton more safety than a lot of today's equities offer you, correct?
That's true. And one of the things that I think they make an error in this respect, in that most people really, and particularly individuals, they don't know what is in a bond fund. They don't know what's in it, and they don't have any idea of duration or the quality or anything like that. Somebody just tells them you need to own bonds, okay? But think about this. If you have a period like we think over the next 10 years where it will not be like the last 12, and you really don't know exactly what's going to happen with inflation, interest rates, and all of that. It could go back to 2, it could go to 6, who knows? What I'm trying to say is if I were advising most individuals, I would have to say, why don't you just think about it like this? Why don't you think about keeping that treasury look, first time ever that savings is back, and you can do something from a 470 on the shortest end to 5 years out, still at a 4. And all of a sudden, you're creating a really great cash flow with very little risk, by the way. They're not to say there's not any. And then give yourself a chance to look at it the next 2 or 3 or 4 years to see, how's this thing panning out? Why do people have to go out and try to guess what the Fed's going to do, and we're going to buy those long bonds and take a bet? I just don't think it makes sense.
All right. Well, and that is the name of the game in terms of wealth building over time, Ted, right? Is it's try to avoid taking the unnecessary risks that set you back if your thesis goes against you, and try to have an attractive but risk balanced way just to keep growing as consistently as you can over time. So I love that reminder. And on the point of bonds, folks, if you're watching, if you're taking to heart what Ted's saying, and if you're like most people, very well, you may never have bought a bond directly yourself. I hear a lot of times from people, who watch these videos who just say, I'm kind of interested in this topic, but I just don't know much about it. Want to remind folks that we did a really good kind of primer on understanding bonds and how they work 2 months ago with Mike Leibowitz from Real Investment Advisors. It's about an hour presentation with another hour and a half of him answering questions from the audience. So if you want to go watch that totally for free, just go to wealthion.com/bonds. a free, very useful resource for you there. All right. Well, look, regarding bonds and interest rates, sort of switching over into stocks now, but you have a chart here showing interest rates and stock prices, and basically saying, the stock market's had a 40-year tailwind that it's been able to enjoy, right? It's just had this secular trend of lower and lower interest rates that fueled a lot of the capital flowing into the equity markets, made, credit money really cheap for companies to borrow, buy, invest, buy back their shares with, et cetera. And you can see what happened with stock prices as a result. But now your chart shows that secular decline may be over. A reasonable person could expect that relationship to continue, but it's now just going to be inverted, where, if interest rates are higher going forward than they have been in the past couple of decades, that we would expect equity prices not to be as well supported. So can you just opine a little bit more about what you expect there?
Well, I think people forget, or at least they don't give credit where credit's due, and that is, with a declining interest rate environment over this whole 40-year, that's a long time, a 40-year period, then, it's been hard not to make things work. I mean, anything, real estate, private equity, private business, anything you invested in, stocks, bonds, everything had that going for them, because the cost of capital kept going down and down and down. And so let's say that you go into a period, and this happens in our business, where you have a change. Something changes, and you go into a time where all of a sudden, let's say we're going to stay around 3 or 4% inflation for the next 10 years. Maybe we go to 2, or maybe we go back to 6 and back to 3. All of a sudden, though, it's not that 1.5, 2 that was just stuck there for 10 years. You have to get in a position where you're starting to look at things now, and what's that inflation rate going to have? What's impact on my investments over a 10-year period? Let's just say it averages 3.5. Well, that's going to impact me 40% probably in the end. And they forget about that. And I've seen this before. I'll give you an example. People were so hung up on high interest rates from basically 1970 to 1982 that when they flipped the lid in August of 82 and rates started down, it took people 3 or 4 years to realize that, hey, there's a change going on here. And they stayed with the old system, what they were doing. It took a long time for them to realize that, hey, it's not like it was. Okay. And so that's sort of where I think we could be today.
All right. And I think that really underscores the value that a firm like yours brings your customers here, Ted, which is the active management approach takes on a much more superior importance in the environment that you think we're heading into here, right? So, with that tailwind at your back, with the Fed being willing to intervene at any given moment to, protect investors from any bruises that the market might be trying to give them, anybody could make money. All boats were rising. You could basically throw a dart and do fine. In this new environment, it's not going to be that way. In fact, it's going to be sort of inverted in terms of the trends. So you're really going to have to do the gumshoe detective work of finding, the diamonds within each sector that are well run, well capitalized, have good growth prospects, and really being able to sift the wheat from the chaff is what's going to determine, much more importantly, who does well going forward. So I just want to underscore, I always say in this program, folks should work with a professional financial advisor who understands all these macro issues, but I think that's even more important given the type of environment that we're headed into.
Well, it is for a couple of reasons. Number one, if you look going back to 2009 until now, these bear markets were 5 or 6 weeks long. So if I've been in the business less than, say, 14 years, that's what I saw until 22. And then I had to deal with, well, gosh, this thing's gone down all year. And it's interesting because when we have new money come into the firm, and one of the things that we get told more than anything else really is, I have all these exchange traded funds, et cetera, but nobody's ever done anything. They just look at it. And I think that's a lot of what's going on Wall Street today. They're just looking at it and thinking, it'll be okay. Don't worry about it. And that's normally not the case, and ever. So we'll see how it pans out in the long run.
Well, we've talked in the past, Ted, about this dynamic where everybody's professional muscles are developed for the environment that they've, built their careers in.
Mm-hmm.
And because we're at a secular shift, we may very well have the exact wrong musculature in our professionals than we need for what's going forward, right? And to your point, like a lot of Wall Street, and I know this because I interact with a lot of capital managers and financial advisors. The way the model has mutated into over the past 10, 20 years of this hyper supported market is the skill set of most of these guys is marketing. It's getting the capital in the door.
Yeah.
Like I said, you can just have the monkey throwing darts in the back room in terms of the allocation, right? So these guys are very good at knowing how to bring capital in, but they haven't really focused all that much on the management of it. You're basically saying going forward, it's the management that's going to be really critical. Well,
and I would say this to you, because I've seen these ups and downs over, 45 years. And what happens is in the industry, but I will say for sure since in the last 13 or 14 years, and I would compare it, by the way, to the residential real estate brokers. I think these two industries were on such a move that just kept going easily that you get all sorts of people in the business, both businesses, and they don't really know much about what they're doing. They just show up. Well, when times go bad, you have to know something, and I think that's where we are now. I think I think our industry, by the way, has too many people in it. And what it will do during these periods is you shake them out. And I've seen it before. Your numbers go down. And I suspect that'll happen in residential real estate too.
I completely agree. And I mentioned my interview with Nick Jurley. He, I think right now, is predicting about 30% of realtors will not renew their licenses during this downturn, that it's going to shake out about a third of the market. And to me, that feels about right, similarly in terms of the financial advisory space too. And Ted, that's why I really appreciate being able to bring on guys like you, and of course, Wealthion's endorsed advisors who come on this channel every week, so that people can at least get a view of the type of advisor that I think is going to, be coincident with success going forward. And so they can get a sense of what to look for in the type of advisor, because you're a good model, in my opinion.
And there's another thing in there, Adam, I think people don't realize, and that is if you look at the fees that have been charged generally, on top of mutual fund fees or exchange traded fees, then they'll put a management fee on top of that. If you look at that over the last 12 or 14 years, I remember greatly in a meeting when I was a younger guy, and the person looked across the other guy that was making the presentation, says, it looks like to me the last 3 years you made more money than I have. And I think some of that will go on. I think they'll look and say, I'm paying a lot of money here, and I'm really exactly where I was 5 years ago as far as what I own. There has been, nothing's changed. And I see a lot of that coming to fruition here.
Yeah, and one of the reasons I love to have you on this program, Ted, is you have the view of experience where, so much of what everyone's wrestling with today, it's a rhyme of a theme we've seen earlier on in history, right? Which
sure,
gives you confidence in terms of what to project. And so that your last comment there is a riff on the old joke that I think was made back in like the 30s of the broker showing his friend his yacht in the marina, and his friend asking, "Okay, but where are your clients' yachts?" Right? Just basically.
I still have the book.
Okay.
Where are the customers' yachts? I still have that book.
All right. Yeah. So again, this is just a rhyme on that theme. All right. Well, look, heading over into stocks now. We talked about how if there is a secular shift in interest rates and in bond yields and inflation, that may be a sign the gravy train for stocks generally is ending. You also have put up a chart about M2 money supply, showing as well that in your data set, which goes back to 1960, Every single year of the data set, money supply as measured by M2 increased, except for this last period. So in terms of like things being different this time, this definitely seems to be a big one.
Well, and I have to say, Adam, and you know our friend Lacey Hunt, I ran that by Lacey because he's such a historian. I said, Lacey, am I right on this? And he came back and said, yes, you can use it. You're right, because we pull it off Federal Reserve. But the thing about that is this is what people don't realize. When you're pulling money out of the system and you're going into a really tight money period, all of a sudden, that's underneath. You can't see that, but that's where you get into trouble, because now you go get a loan or you go get some sort of financing and people are like, hey, you know what? We're out of the market, And so that's the sort of thing that starts to happen, like Wells Fargo yesterday getting out of the housing mortgage market in a big way. All of a sudden you start to have these people pull out. And I think people don't realize what happens. And if the Fed stays on the same rate they've been running at, by the time you get to April or May, you're going to be back at a point where they have really pulled a lot of money out of the system. And when that happens, loans will dry up. And again, all of it fits together for the economy, but that's what we see with that.
Yeah, well, to borrow your opening statement here, that there are a number of shoes that are sort of preparing to drop this year. I feel like we're identifying a number of them. And yet another one that you put up was profit margins, right? Which is, they're still near all-time highs. As I believe it was Jeremy Grantham said, profit margins are one of the most mean reverting data sets in all of finance. And for a lot of the reasons you've already discussed about your concerns about the economy slowing, it just seems like, we've tossed the ball up in the air and it's hovering there at its apex. And science just tells us it has to start coming down. So how big a deal do you think reversion to the mean in earnings is going to be this year?
Well, I think that's the one thing that Wall Street misses. Now, I've been watching them. I think I used in the letter that the average on the street was $231 for S&P on the street consensus. For us, we think it's less than 200 somewhere. And along that way, what happens is, I think people forget about this, but look at all the inputs to public companies over the last 10 years. Their financing kept going down and down as far as the cost. Globalization helped them quite a bit. Well, that's going away now. Everybody's saying, hey, I'm pulling back into my country now. That's going away. All of a sudden, with inflation, people on the wage side are saying, hey, I'm not going to work for that. You have to pay me more money if you want me in the loop here. So if you put everything, and then cost of goods have gone up. Now, obviously they're coming down some on the commodity side right now. That's true. But if these other things stay up, okay, then you're going to be in a situation where those margins have to come down. I cannot see them not coming down more than people expect. So if the margin comes down, then the profit comes down, and then the multiple comes down. And that's how we look at that three-way.
Okay, yeah, and just to make sure folks understand, stocks are generally priced on two ways. You hear about the price to earnings ratio, right? So the price is a function of earnings. Usually there's a multiple that's placed on earnings, right? And we have seen some contraction over 2022, Ted, in terms of PE multiples. But you're saying, there could be still more reason for the multiple to shrink. And when that multiple shrinks, it brings the price down, assuming earnings are constant. But you're saying earnings are actually likely to be lower going forward than are currently expected. So even if the multiple remains the same, stock prices can come down as the earnings expectations shrink. So we've got sort of two factors that could be continuing to bring stock prices down next year: lower earnings than currently estimated, and also people getting worried and bringing that multiple down too, correct?
That's correct. And I think what people forget to realize, let's just take a 4,000 number for the S&P 500. And let's say we happen to get it right at 200, not lower than 200, just 200. That's still 20 times. Okay, that's not a cheap market by any stretch. That's not cheap. And so at bear market lows, you usually go under the 14. You'll go to 11, 12, 13 times. And And so when you start making these adjustments, I think that has to get priced in, and therein lies the fact that we think you may not get it, but you have to be aware that there could be more significant weakness if those numbers keep on falling.
Yeah, and I'm not saying you're necessarily calling for this, but if we have a 200 earnings per share on the S&P and we get to a bear market multiple of a 12 or 13, I mean, that's sort of like in the high 2000s, right? I mean, that's like at least a 30% drop from where we are today.
Yeah, and I think even if you said 15 times, I mean, you're looking at 3,000 on the S&P, and I just think people are not aware of what the numbers are, and they've been sold this mantra that don't worry about it, it's a long-term deal, and you'll be fine. But I think I've told you this before, but I've always had a saying with all the portfolio managers at Oxbow that almost everybody is long-term if you talk to them until they lose money. And then they're short-term.
That's very true. And again, that's the value an advisor brings is, as people, our emotions and our sense of under or overconfidence tend to be our very worst enemies here. And having a partner that can really ground you in reality and consistency can be a really big asset. Ted, thank you so much for the time you've given us. I'm working my way towards your portfolio allocation. If you've got a few more minutes,
Sure.
I'd love just to ask you one or two more things about your investor update. Is that okay?
Totally okay. I will say, Adam, you've developed such a great show over the last few years, and I know you have a huge following. So I'll do whatever works for you.
You're much too kind, Ted, but thank you. All right. Well, look, there's a chart that you showed that I think really underscores kind of the big risk that we're talking about here. And this is the chart of non-profitable tech from just the beginning of 2020 to now. So basically past 2 years, right? And it has completely round tripped. It grew by more than 400%, but is now off by almost 80%. And it's pretty much back where it started from 2 years ago. And that's the math, I think, that most people just aren't doing there in their heads. And of course, this is an extreme example, but as recently as a little over a year ago, folks thought that index was going to increase by another 400%. They just could not conceive that it could drop, let alone even flatline. But of course, it's given up all those gains that it had since just the beginning of 2020.
Well, it has, and I pull that off Bloomberg all the time, just so I can sort of look at it and see where it is. And it obviously is back to where it was, but it looks like now though it's going to go lower. That it's actually going to go under where it was in 2020, and that being the case. But there's so many companies I never saw in my time in the business so many companies that were trading that didn't make any money. And I used to look, a year and a half ago or so, I used to look at this ARC fund, that sort of thing. And I'd say, well, in my opinion, that's going to be like the Munder net fund. Now, for those that haven't been around a long time, that was the hottest thing going in 98, 99, 2000. And then over the course of a 3-year period, they lost it all, 100% almost, went out of business. And so when you own all these companies, yeah, you can say what they are, but you have to remember in investing, I don't care what investment it is, it could be any kind of investment, not just stocks and bonds. It's cash flow. You got to have cash flow. And so all those companies have no cash flow. And on top of that, they're burning all the cash they do have. And so that's what they're up against right now.
Ted, what's so important about that is you and I have known each other for enough years now that I saw how you comported yourself during that massive melt up in big tech. I'm in particular thinking about Tesla, right? Which, from a cash flow perspective was valued at a gargantuan valuation versus its actual cash flows. And then the whole Bitcoin crypto extreme boom as well. And I really have to commend you for, how you sort of just kept everything in perspective. And again, I think it's because you have the historical advantage of having seen versions of this movie before to not get caught up in the crazy FOMO that just sort of seems to infect the majority of the rest of the financial markets. And I think having that grounding and that experience is so incredibly valuable, because it is really hard for the average investor to resist that siren song, especially when so much of the official Wall Street, establishment is cheering that same thing on and basically selling them the message: if you don't get in now, you're going to be left behind. You don't understand it. Everything's different this time. And so, it's not necessarily sexy to be the guy at the party saying, "Hey, everybody, I think we're overstaying our welcome here. The cops might be coming soon." But it's that kind of prudence that just saves, can be a lifesaver in terms of wealth protection.
Well, one of the things I bring out in the piece that you're talking about, that with the magic of it all, was get rich quick scheme. Okay. You look at all those things, they're just the same thing. Okay. Let me just bring an idea to you. It doesn't have to make any money, and we'll throw it out there. People will like it and they'll buy it. But what happens and I put a line in there, the reason it's magic is because now you see it and now you don't.
Yeah.
All right. And that's really what's happening right now. And, I find it really interesting, and I'm not an anti-crypto person. I just think that it's probably limited to just the upper group. I think, I follow them, so I always know how many coins are out there. It got up over 10,000 at the high. Now it's down, to 8,700 or something. But surely most of those are not going to do well. In fact, they haven't done well already. They've lost 70, 80, 90, 100%. So that's how we looked at that. But Wall Street picked up on it too when they did SPACs and they bought these companies and they did the funds where they were doing these startups. It all folded together, and I've been around too long. I know what happens in those things.
Well, look, we mentioned this earlier. I'm going to put up the chart for it now. But you said, look, people are beginning to get nervous, right? They've got the cuts and bruises of 2022 to prove it. But what's interesting is, even given the outlook that you and I have just spent the past hour talking about, they're still positioned as if it's business as usual in the markets right now, right? People are still pretty much fully invested. They're still pretty long. What do you think it's going to take for people to actually start changing their investment behavior?
Well, I have a theory on it, really, and that is, if you look at most investors 19, 20, and 2021, and you put those numbers together for the average person that was in ETFs or indexes or whatever, they did really well, and no question about it. And so what's happened is, when you get the first down leg, which is, let's call it 25 or 30%, depending on how they're invested in those, it hasn't taken away enough of those 3 years yet to make them really they're like, yeah, but I still made money over the, this period. I'm looking back to where I was at the beginning of January 1 of 19. So that's, to me, that's my theory of what's going on. That means that in order to really shake them out, you're going to have to go to a lower low where all of a sudden they look up and say, and now I'm really losing money. And when that happens, they pull a trigger, and that's what I think will happen.
To use a relationship analogy, your girlfriend's not coming by anymore. She's not answering your calls, but you're still not willing to give up hope on the relationship until you actually see her dating another man, right?
That's true. And then even then, don't believe your lying eyes.
Yeah.
So that happens too.
Well, look, the reason why we brought the conversation to this point is because, Ted, when I've had you on in the past, you've talked about how bear markets tend to end, right? And they tend to have a couple of different phases. And the last phase is sort of when people finally decide to believe their lying eyes, and they just break the relationship. They break up with the markets, right? They say, get me out. All right, I've lost way too much money. I want to sell it all. Don't even talk to me about stocks or bonds anymore. I just want to go nurse my wounds in a corner. I don't even want to touch these things ever again in my life. And I recall you saying that these bear markets tend to end with that last capitulation phase, which is where you sort of see like a sudden waterfall of like the last 25% of the drop happens pretty violently and quickly right at that end as everybody just kind of gives up on the market. And given current investor positioning, like we just talked about in that chart, it doesn't seem like we're anywhere close to that yet. So again, I want to take a pause here for a second because I'm going somewhere with this. Is that still the way you see it, which is that it's more likely that we still have kind of increasing downtrend and then a major capitulation event?
For sure, because what we see now, and I do this from time to time, I'll just be around people that we don't do business with, but just say, how's it going out there in the marketplace or whatever. I just had one 2 days ago. And she said, well, I had $1 million in my 401k. She's a vendor for us. And she said, but now it's down to about 800 or 795, something like that. And I said, so you made any changes? She said, no, it'll come back.
It'll come back.
I'm not too worried about it. And so I think that's pretty much the mantra that's out there. So what has to happen is you have to get to a point where they say, now look, I'm not going to lose any more money. And that's, unfortunately, that is the plight of the smaller individual investor. They have nobody to really help them say, okay, you need to get liquid here and then put it in here. And they, it's just, unfortunately, they don't get good advice. And I think that's what's happening right now.
Our interview with Ted will continue over in part 2, which will be released on this channel tomorrow as soon as we're finished editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as that little bell icon right next to it. And be sure to hit the like button too while you're down there. And remember, we're continuing our practice of publishing my top takeaways from these weekly interviews. To get mine from this interview with Ted for free, just go to wealthion.com/AdamsNotes. And finally, if the challenging macro outlook Ted has detailed in this interview has you feeling a little vulnerable about the prospects for your wealth, then consider scheduling a free, no strings attached portfolio review by a financial advisor who can help manage your wealth, keeping in mind the trends and risks that Ted has mentioned here. Just go to wealthion.com and we'll help set one up for you. Okay, I'll see you next over in part 2 of our interview with Ted Oakley.